I'm joined by Ian Williams, CEO of Charteris Portfolio Managers. He manages the City Financial Strategic Gilt Fund, the best-performing fund for British government bonds since its launch in 2006, and even beating PIMCO's performance. That's according to research firm Lipper. So we'll get to the bonds in a minute. But first of all, I want to ask you about gold, because we've seen it hitting fresh highs. Is this rally likely to continue?
Well, we think so. We run a gold fund as well, as you know, and that's up. Oh, I think it was launched 6 months ago. It's up 25% since launch, and we think that the prospects of gold are that gold could move substantially higher, whereas we think the government bond markets are in a bit of a bubble and are actually potentially quite a dangerous investment at the moment.
Why is that? What are the drivers? Why are people shifting into gold and silver?
Well, when you've got the Federal Reserve saying that inflation's too low and they want to boost it, it would seem extremely perverse for us to go rushing into long-term government bonds if the aim of the Federal Reserve is to stave off a recession and boost inflation. But it's no surprise that investors will then go and look to buy assets like gold and silver, which are traditionally inflation hedges.
So how might a further easing of monetary policy impact on the price of gold?
Well, quantitative easing is effectively printing money. So, I mean, crudely put, the more money they print, the higher the potential price that gold can go to.
And what sort of bonds are you favouring right now?
Very short ones. We think the gilt market and the US Treasury market is in a bubble, and people are mistaking quantitative easing as being bullish for bonds when we don't think it is. If you look at the example of the UK, when they introduced quantitative easing, it did absolutely nothing for the UK gilt market. There was a big flurry of excitement when it first came out. People thought it was hugely bullish. It turned out that gilts actually went down over the period of quantitative easing. Equities, on the other hand, went up 50%, and gold went up. So printing money, which quantitative easing is not particularly bullish for bonds, but is extremely bullish for inflation hedges.
Nevertheless, the Fed is signaling that they'll do what they need to do to boost the economy. Also indications that the Bank of England could do the same. So in the event of another round of stimulus, further QE, which bonds would benefit?
We don't think they will. I mean,
you don't think they will at all? Not even long-dated securities?
Because, OK, so the central bank is buying bonds, but the US Treasury is selling a lot more of them. The US government is a heavy net seller of bonds. It's just that the Federal Reserve is buying some of the bonds that the Treasury is selling. It's not buying all of them. The same thing happened over here with the Bank of England.
So how would more stimulus then affect your thinking, your strategy?
As I say, the more potential easing that you have, the higher the potential that gold can go to. Gold is a much more attractive asset in the light of what's going on than bonds are, given their current relative value.
Nevertheless, what are the risks of gold at the moment, given so many people are piling into the trade?
Well, are they? I mean, you know, we've got some data showing that exposure to gold assets is incredibly low, especially amongst central banks. If you take the Central Bank of China, which is probably the biggest central bank in the world in terms of its assets.
So you don't think there's a gold bubble right now?
No, there's a bond bubble.
There's a bond bubble?
Yeah, I mean, the Chinese central bank has 92% of its assets in US Treasury bonds and 1% of its assets in gold. That's not really, doesn't sound like a bubble to me in gold, but it does sound like a bubble in bonds.
OK, well, thank you very much. Ian Williams, Chairman, CEO of Charteris Portfolio Managers.